This video is brought to you by Chetan Patel, CEO and founder of MWH Holdings Group. Ever wondered how the value of a business gets determined? What are the factors that can unlock its true worth? It's a fascinating question, isn't it? Business valuation is like a complex puzzle with many pieces. Each piece represents different aspects of a business. Some pieces might represent the company's assets, its cash flows, or its market position. Others might represent the company's future growth prospects, its competitive advantages, or even the industry dynamics in which it operates. But here's the interesting part. The true value of a business often lies hidden, waiting to be unlocked. This is where the concept of value unlocking comes into play. It's about finding those unique pieces of the puzzle that can potentially enhance the business's value significantly. So let's dive into the world of business valuation and value unlocking to solve this puzzle. It's not just about numbers and ratios. It's about understanding the story behind a business and its potential for growth. Decoding the value of a business is not rocket science, but it does require a good understanding of some key concepts. Let's dive into the basics of business valuation. Picture it as a process, a method of determining the economic worth of a business or company. It's like putting a price tag on a house, but instead of bricks and mortar, we're dealing with assets, income, and potential. So, how does it work? Well, at its core, business valuation is about assessing the financial performance of a company, its position in the market, and its potential for future growth. Let's unpack that a bit. When we talk about financial performance, we're looking at a company's balance sheet, income statement, and cash flow. It's not just about the numbers, though. We also consider factors such as the company's profitability, its debt levels, and its ability to generate cash. Next, we have market conditions. This involves a closer look at the industry in which the company operates, the competition, and the overall economic environment. A prosperous industry or a favorable economic climate could boost a company's value, while a downturn or stiff competition might do the opposite. Last but not least, potential growth. This is where we gaze into the future, estimating the company's ability to expand its operations, increase its profits, and seize new opportunities. It's a bit like fortune telling, but with spreadsheets and financial forecasts instead of crystal balls and tarot cards. So as you can see, business valuation is a blend of analysis and interpretation. It's about digging into the numbers, understanding the market, and making informed predictions about the future. It's also a continually evolving process. Business valuation isn't a one-time thing. It changes as the company grows, the market shifts, and new information comes to light. Remember, business valuation is more of an art than a science, and it requires a nuanced understanding of the business and its environment. It's an intricate puzzle, but with the right tools and a bit of savvy, it's a puzzle you can solve. Now you might be wondering, what is this value unlocking we keep talking about? Let's delve into this intriguing concept. Value unlocking is an art form in the world of business valuation. Imagine you're an explorer and you've just stumbled upon an ancient treasure chest. But it's not the glittering jewels or golden coins that capture your attention. Instead, you're drawn to something more subtle yet potentially more valuable, an intricately carved, overlooked artifact. This is essentially what value unlocking is all about. It's the process of identifying and leveraging hidden or underutilized assets within a business to increase its overall value. Now, these hidden assets are not always physical. They could be anything from a patent to a strategic location, an underutilized brand, or even a unique business model. The challenge lies in recognizing these assets and knowing how to unlock their true value. So, how do we do it? Well, there are several strategies for value unlocking. One of the most common ways is through operational improvements. This could mean streamlining processes, enhancing efficiency, or adopting new technologies. By improving operations, a business can significantly increase its productivity and therefore its value. Another strategy is financial restructuring. This might involve re-evaluating a company's debt structure, capital allocation, or even its entire business model. By optimizing these financial aspects, a company can unlock value and enhance its financial health. Then, there's the method of strategic acquisitions. By acquiring a company with a unique asset or capability, a business can unlock new value, gain a competitive edge, and potentially increase its market share. But remember, value unlocking isn't a one-size-fits-all approach. It's a meticulous process that requires a deep understanding of a business, its industry, and its potential. Value unlocking is like finding hidden treasure within a business, just waiting to be discovered and utilized. It's a journey of exploration, discovery, and ultimately growth. So let's continue on this journey and delve deeper into the world of business valuation in the next scene. Traditional ratio analysis has been the go-to method for business valuation. But is there more to it? Absolutely. While traditional ratio analysis, with its liquidity ratios, profitability ratios, activity ratios, and solvency ratios, has been a reliable ally in the quest for business valuation, it's not without its limitations. It's akin to looking at a business through a keyhole. You get a peek, but the view isn't comprehensive. Let's break it down. Ratio analysis majorly focuses on financial aspects, which is like looking at the tip of an iceberg. What about the submerged part, the non-financial factors that significantly influence a business's value? It's time we bring them to the surface. First off, the quality of management. A competent management team acts as the rudder, steering the business in the right direction. Their strategic decisions, leadership style, and risk management practices can make or break a company. Traditional ratio analysis, unfortunately, doesn't factor in these nuances. Next, brand value. The reputation and recognition a brand enjoys can significantly boost its value. Think about luxury brands like Rolex or tech giants like Apple. They command premium pricing, not just because of their products, but also due to their strong brand value. Yet, you won't find a brand value ratio in the traditional analysis. Lastly, market positioning. A company's standing in the market, its competitive edge, and its growth potential play a crucial role in determining its value. But alas, ratio analysis doesn't quite capture these aspects. So what's the way forward? How can we incorporate these non-financial factors into our valuation methodology? Here's where alternative methods like discounted cash flow analysis and real options valuation come in. Discounted cash flow analysis, or DCF, goes a step further than ratio analysis. It projects the future cash flows a company is expected to generate and discounts them to their present value. This gives a more forward-looking perspective of a company's value, incorporating its growth potential and risk factors. On the other hand, real options valuation, or ROV, treats business decisions as options that can be valued. It captures the value of managerial flexibility in responding to changing market conditions. This means it can account for the quality of management, a factor often overlooked by traditional ratio analysis. To sum it up, traditional ratio analysis is like a trusty old compass, guiding us in the right direction. But in today's complex business landscape, we need more sophisticated tools like a GPS, which take into account multiple variables to give us a more accurate picture. So, while ratio analysis is a useful tool, it's important to look beyond the numbers to understand a business's true value. So, what have we learned about business valuation and value unlocking? In our journey through the complex world of business valuation, we've unraveled several crucial insights. The first takeaway is the understanding that business valuation isn't purely about numbers and ratios. It's a multifaceted process that goes beyond traditional financial analysis to incorporate a range of non-financial factors. It's about understanding the business's unique qualities, its competitive landscape, and the potential for growth and innovation. We've seen that the basics of business valuation are rooted in financial analysis. This includes assessing profitability, cash flow, and various financial ratios. But we've also discovered that these traditional methods only tell part of the story. To gain a full picture of a business's value, we need to consider other factors such as its strategic position, its intellectual property, its brand strength, and its human capital. As we moved beyond traditional ratio analysis, we uncovered the art of value unlocking. Value unlocking strategies can significantly increase a business's worth by identifying hidden assets and potential growth areas. These strategies might involve restructuring the business, leveraging underutilized assets, or innovating new products and services. The potential of value unlocking is immense. It can transform a seemingly average business into a powerhouse, or turn a struggling company into a success story. It's about looking at the business from every angle, identifying opportunities for enhancement, and then strategically implementing changes to realize that potential. But remember, every business is unique, and what works for one may not work for another. The key is to understand the specific characteristics of the business in question and devise a tailored approach to valuation and value unlocking. Remember, understanding the value of a business is like solving a puzzle, and with the right approach, you can unlock its true potential.